discussion. So R&D costs are huge these days. The American economy over the last arguably 2.5 decades, has really shifted from an industrial economy back in the 40s, 50s, 60s, started transitioning probably 70s, 80s to services, 80s, 90s into tech, and now just super tech heavy. It's science service generating sort of development companies, pharmacy companies, biotech companies, pure software companies, even now automobile industry is starting to become more tech. Research and development costs are huge in current company reporting. So, you got two pieces really, and the fact that it splits into two is only truly important in a IFRS international world, because they draw a slight distinction between research and development. But research, of course, is an attempt to discover new knowledge. We're thinking things through, hoping to have an idea that's worth pursuing. Then development takes that knowledge of, oh, here's this idea I want to pursue, let's bring it to fruition into a new product or process. So gap everything R&D, whether it's in the research phase or the development phase, it's expensed. So we expense any internally generated R&D costs incurred up to the point of what we call commercial production. That means that every expense is recognized as R&D expense. This includes any materials, equipment, facilities, and tangibles. All of this is R&D expense. There is an exception if I buy, for example, PP&E or an intangible that has some other alternate future use. So like I buy some equipment that I think I can use in other R&D projects. If that is the case, then you can capitalize the asset as equipment, or perhaps a patent, or whatever that asset is. It escapes that R&D expense designation. But when we have cost allocation, i.e. depreciation or amortization on this item that was capitalized because I can use it in a future project, this depreciation or amortization is also R&D expense, even though its asset is usable in other things. As long as it's being used in the R&D process, we treat it as R&D expense. Personnel costs, so salary positions of workers, our employees that we have working, it's not wage expense, it's not salary expense, it's R&D expense. If we contract with another company for their services, R&D expense. Any indirect costs also included in R&D as they are incurred. It's harder to break apart general and administrative costs unless they are clearly related to R&D activities. So most of those do not get the R&D expense designation. The exceptions. The first isn't really that amazing. If you're doing R&D work on behalf of someone else, you're not doing it for yourself, then it's more of a like inventory or service asset. It is not R&D. Capitalized assets, like I said, any asset or intangible that's purchased in pursuit of R&D if future uses exist. If the asset is only for use in the current project, it's expensed as R&D. So you could have a $5 million piece of equipment. If it's only good for this project, it's a $5 million R&D expense. After the start of commercial production, items are no longer recorded as R&D expense. either you expense it by the alternate name, or add it to the cost of inventory and process if appropriate. But it just goes back to, like, if I was paying employees and they were working on a project last quarter, it might be R&D expense, but once we hit commercial production, it goes to salary expense. You know, I was using a piece of equipment in my R&D process. Last quarter, it was R&D expense. If we've hit commercial production, it just goes back to to depreciation expense. So there's this sort of timeline where we hit commercial production, and everything before that threshold of being able to actually produce this item for commercial uses, all of this is just expensed as R&D. Over here, normal expenses come back into play. And this is important. The labeling of the expense is important because investors, when they're valuing a company, when an analyst is valuing and forecasting earnings and the potential value of the company in the future, R&D expense is not the same as other workaday normal expenses. This actually allows some speculation for future value development, whereas most normal expenses don't have the same speculative development of value for the company in the future. So why is it that we're so conservative with these things? Normally, we only recognize expense when the period that it helps generate revenue. Well, for R&D, there's a couple of issues with that. First, it's difficult to identify costs with particular activities and projects. So when I'm researching, you know, sometimes I'm researching in one topical area, and then the fruits of that research could go into 5 different ideas I have down the road. This happens to me all the time when I'm doing my academic research. I'll be looking into you know, when do banks sell securities for gains and losses, and do they do it for earnings management or for reductions of information asymmetry? Then I get all these other ideas that I see in different papers, and I'm like, oh, well, how does this relate to another project? Or how could this be done with this regulation in mind? And so you start to spin off when you're in this research area. You haven't necessarily started developing, but that research can map into a whole slew of products for a company in the future. The other one, and the one that's a little easier to identify and see, is that when we're researching and developing, we still are sort of a pie in the sky attitude about what this asset is, when it's going to come to fruition. Is it going to be something that generates massive amounts of revenue for the company? Maybe it won't at all. Maybe we're researching in tandem with another company to come up with the same or similar product or patent. If they beat us, that could totally eliminate any of the economic benefits we expect to generate. And so with the matching principle, we're trying to match costs with the period in which we're going to get revenues from incurring those costs. Well, that becomes really hard and near impossible with R&D. So we don't have to, but we choose to treat it conservatively and recognize the expense immediately. What's deficient about this, right? When we immediately recognize the expense, we don't recognize costs to the revenues that might happen in the future, right? All R&D for the COVID vaccine for those companies was expensed up until the point that it was ready to be shipped off the shelf. Well, they've already spent most of the money that was needed at that point. At that point, they were just manufacturing COVID vaccines. So all that money they spent was not matched appropriately to the billions of dollars of revenue they generated after those vaccines were starting to be sold. We have a violation of the matching principle. But it's tolerable because, like I said, it's hard to really determine how long it's going to be until we can match those costs. Um, Another big drawback is that because we're expensing, we're not allowed to capitalize any of these expenditures. One of the, potentially largest future economic benefits of a good portion of our companies, and an even larger market share, if you look at just what the market cap of tech companies are, their assets tend to be understated because they have a lot of R&D expense. They're generating a lot of future economic benefits with their R&D expense. We just can't allow them to show it until commercial production begins to happen. And by that time, like I said, most of the heavy lifting has been done. Most of the dollars have left the building. Once we hit commercial production, it's just the sort of normal product expenses that tend to go through. And interestingly, as a result of this, investors and analysts, like I mentioned, tend to work around the accounting. They treat the expenditures of R&D sort of like an asset, even though the company is listing it as an expense on their income statement. And so that's why, you might be like, well, what does it matter if we call it R&D expense or we call it depreciation expense or salary expense? It's all hitting the income statement. And you're right on that sort of very superficial basis, but because the users of financial statements treat it in such a way, that distinction becomes very important to deliver on and to make sure it's done appropriately, right? I do want to wrap up. I won't go into software development costs this time. We'll talk about it maybe next time. But let's just look at this company. We have Bio Company. They've incurred a variety of costs, expenditures, a new pharmaceutical product, the straight line depreciation on their assets. They got these expenditures listed below. They paid employees $500,000 for the year. Purchased machinery for $400,000 has alternate future uses. Outsourced some research issues to Colt Inc., paying $100,000 under contract. Purchase rights to a patented process. The patent will not have any future use, but its useful life is 50 years. So employees in its R&D division, $500,000. This is R&D expense. You can put them all together, but I'm going to list them separately as separate journal entries. R&D expense. And I'm assuming all of these are prior to commercial production. So we have R&D expense for 500,000 for those employee salaries, and always assume cash unless I tell you otherwise. Could be salaries payable, but whatever. Purchase machinery, it does have alternate future use. So because the machinery, you could call it equipment, it would be the same to me. Has a future use, I can capitalize it as an asset. Again, I'll just assume it was cash that I purchased this with. Now let's assume that we bought this machinery at on 1/1. And we had a full year's use. So when I adjusted on 12/31, if I have not yet met commercial production, this is what I meant about that R&D expense instead of depreciation. If we're using straight line, 400,000, 10 years, that's $40,000 of depreciation expense per year, but it gets recorded as R&D expense rather than depreciation expense. And I credit accumulated depreciation. So the credit doesn't change. It's just that instead of debiting depreciation, I debit R&D. If I paid somebody, outsourced some research issues to another company, I paid them $100,000 under a contract. Hey, that's just R&D expense. And the final one, I purchase rights to a patent 350. The patent will not have any future alternative use. And because the patent is no future use, it all goes R&D. Don't get to call it a patent. And there's no reason to apply cost allocation to that. You know, it doesn't matter. I don't have to assess the lesser of the legal life or the useful life, which would be the legal life in this case, which I think is 20 years, and then divide that by 350, divide that into 350, because I've already recognized the entire cost of the patent as R&D expense. It's been expensed. There's no need to apply any additional expense. And so the allocation for this becomes moot, irrelevant. In the case of the machinery, right, I did not classify that machinery as R&D expense because it has future alternate uses. And therefore, it was pertinent for me to apply cost allocation so that this $400,000 gets recognized as an expense over its useful life, even when it turns back to simple depreciation expense after we reach commercial production. All right, so that should definitely get you through the homework. There's no software on there, and software only is different in that there's an additional small window for companies to actually capitalize into an in development software account. But I'll talk about that on Tuesday. And then head into the chapter 11 materials. So thank you guys for coming. I know it's Sunday, last thing we want to do, but definitely of use. So y'all have a great weekend, and I'll hang around if y'all have any other questions or any concerns.